everybody. My name is Kyla. Welcome to my channel where I talk about the stock market and the economy, amongst other things.
My mind is a barrel, loaded clips in my guns.
There has been a lot of noise recently about China and the China Crackdown. All that I'm going to talk about today is just a really basic overview. I'm not saying anything. This is not my personal opinion about what's going on in China. That's a piece for a different day. This is more so about fund structure and index weighting. So more so about market mechanics versus anything about China as a country. I'm not trying to pass opinion off on that. It's what I am trying to pass an opinion on is how indexes are structured here in the United States. So that's my opinion, and that's what I'm going to be talking about. Getting into the role of tech in investing, China recently cracked down on the edtech sector. If you haven't seen news about it, I highly recommend searching it up. It's pretty interesting, pretty widespread. They've been cracking down on various things this entire year, and most recently the edtech sector, but we saw it happen with the canceled Ant Financial IPO. We saw it happen with Jack Ma disappearing into oblivion. We saw it happen with the penalties against Didi, and then a lot of antitrust measures being levied against Tencent, Baidu, etc. They have a lot of reasons for going after the edtech sector. Primarily, they want to restructure how education is seen. A really interesting piece by Noah Smith that talks about how China sees tech differently than the United States does. So the United States will say that Facebook, Google, etc., they're all tech companies, but China will look at semiconductors and other hard tech companies and say that those are tech companies. And so China doesn't see consumer social in the same light that the United States sees consumer social. Everybody wants to be in the consumer social space in the United States. Everybody's building some sort of social investing app. Too many people are building social investing apps. In China, that's not what they want. That's not what they want to be known for. And so they're going to crack down on sectors that are implementing those strategies that are like, hey, we're going to build something that's social. Hey, we're going to build something that's consumer facing, and saying, no, you're not. We're going to focus on semiconductors. That's what we want to be known for. We're going to focus on hard tech. We're going to focus on actual technology, because that's going to be much more powerful for us down the line than having a bunch of Facebooks, even though Facebook will eat the world one day. But I mean, that's the main thing is China really wants to be powerful, and the way that they think that they're going to do that is through levying hard tech, and the way that they're going to make sure hard tech takes over is by getting rid of all the soft tech companies, which are the consumer social apps. This conflation, though, has confused US investors, because US investors look at China tech and they say, oh, it's the same as US tech. So they invest in it the same way that they would invest in US technology companies. But you can't do that, right? Because China's going to crack down. And so that ends up in a resulting bloodbath that US investors are not prepared for, because they don't necessarily realize that China doesn't see technology the same way. It's really interesting because global holdings of Chinese stocks and bonds have surged about 40% to more than 800 billion over the past year as investors bought assets at a record pace. If you look at the reason behind this, a lot of it has to do with index inclusion. So you have non-China emerging markets have completely fallen off the bandwagon in terms of index inclusion in favor of China. And I'm going to talk really quickly about how Cathie would positioned herself. And I talked about her in a video a long time ago, but she sold out of all her Chinese tech companies and said that they were overvalued, which is something that you never think you would hear Cathie would say about anything, is that something is overvalued. So the fact that she said that was really interesting, and she was able to avoid the fallout that happened last week. And the signal that she sent, where, you know, she's one of the biggest thematic fund providers. She invests in innovation. She invests in next-gen technology. And so the idea that she's pulling out of China says something, right? However you feel about her thesis, it says something that her, with all her dollars, is pulling out of the Chinese market. We have the issue of China, right? Like, China wants to focus on hard tech. China was willing to do whatever it takes to make sure that's the main focus. But there's also a big issue here in the United States, where there's the index fund manager relationship. So Cathie was selling, but indices were gathering, indexes were gathering, and they were gathering for quite a few reasons. So China's now about 1/3 of most EM funds, which is really a lot if you think about it, because maybe China's like 1/3 in terms of like overall size, market cap weighting, sure, but that's still a lot of exposure to China, especially relative to how many countries are out there. But here in the United States, it's like a triangle, right? So you have your fund issuer, so your iShares, your Vanguard. You buy an ETF, it's probably going to come from one of these people, BlackRock, who's iShares. And then you have an index provider, so MSCI or FTSE. They're not asset managers. You don't tell people how to invest. They just compile all these assets and build out an index, usually market cap weighted, however it be. The world's biggest asset managers. So you have pension funds. You have CalPERS, which is the California pension retirement system. Ideally, the asset managers would be diversified away from indexes, would be diversified away from funds, but asset managers cannot diversify away from index managers, from the MSCI, from FTSE, because of tracking error. So they have to invest relatively the same in order to outperform the benchmark. They can't deviate too far away because of tracking error. And that creates a really weird situation where you kind of have all three of these entities pretty much invested in the same vehicles. And that results in overexposure. Chinese companies across the board. The index ends up having a heavy exposure to China, and then the fund issuer tracks that, and the asset managers have to follow that somehow so they can beat the benchmark. And funds are thinking about how to solve this. So BlackRock is thinking about separating out China as a standalone market, not a part of EM or DM, just China. The emerging markets or developed markets, China would just be the China market, and that will help with fund structure, but it doesn't solve the overall overexposure issue. Because there's two different types of overexposure. There's general overexposure, where these EM funds have overexposure to China. China's making up a lot of it, and a lot of that's due to market cap weighting. VWO, which was one of the leading indexes, has a 40% weight to China, and this is something that people use to like diversify their portfolio. A 40% exposure to anything isn't diversification. There's also intensive overexposure. So broad EM funds, due to their bigness, broad EM funds, right, are the biggest holders of some of these educational stocks, not thematic funds, not China funds, but broad emerging market funds that are supposed to be diversified across the board, end up holding more of these ed tech stocks, more of these consumer social stocks than a fund that would be thematic around that. So it's general overexposure and intensive overexposure. And then you would be like, well, I could just invest in an ESG stock or an ESG fund, it'd be fine. But ESG funds have the same problem with overexposure because of the tracking error. So they have to stay within a 1% deviation from their non-ESG parent benchmark. So basically, like what all this technical stuff means is because of Oh, Henry, how have you been? Yes, a gentle reminder, MSCI is not an asset manager. Do not tell people what investment decisions they should make. No, Henry, you're an index provider. We don't tell you what decisions to make. We just track you. I'm looking at you, Henry. If you track them, aren't they telling you what decisions to make? We don't tell people how to invest. Important that we don't underperform the benchmark, which is you. So, you can't deviate from that. Tracking error, Henry. Get fired. Listen, we're gonna have a 40% weight just to China. 40% to China. Broad and diversified emerging markets index. Is that really diversification? 40% weight to one country? It's totally diversified. That's so great. Our ESG funds are gonna have to be really similar to you too because of tracking error. I think that there's a problem of overexposure due to market cap weighting. Funds having overexposure, asset managers having overexposure, and just basically everybody's a little bit overexposed here. I see no problem here. I have the solution. Solution to the problem? Freedom weighting solves this. Because of the index, fund, and asset manager relationship, they all end up having outsized exposure, in this case to China. And because you can't deviate from it due to tracking error, ESG funds, which are supposed to be good, and they're supposed to be, they end up with not very ESG results. And because of all this overexposure, every time that this, the Chinese stock bloodbath happens, all of these stocks end up, all of these entities end up feeling the pain. And these entities are things that you would invest in your 401k, VWO. Great 401k investment, hypothetically. Pension funds, retirement funds, like teachers, everybody's invested in this sort of like overexposure cycle. It's super bizarre. Endless loop of pointing fingers too, because the indexes are like, oh no, it's not our fault, we just do this. And then the funds are like, it's not our fault, we just track. And the asset managers are like, we have to stay within a certain amount of you so we can make lots of money. And it just ends up being a really messy cycle. And the whole MSCI and China story is really interesting too, because basically MSCI, which is one of the leading indices, was like, hey, we don't really want to include you, China, like chill out, leave us alone. And then China was like, no, add us now. And so they did. And this resulted in a really good situation for MSCI. Approved 9 Chinese ETFs designed to track the performance of the MSCI indexes when just one existed previously. So all of a sudden you can sell a lot more products when you add China to your portfolio. The SEC actually released a really interesting paper on it. More than 150 China-based companies with a combined market value of 1.2 trillion were listed on US stock exchanges at the end of 2019. So more than $1.2 trillion in the course of 2019. And the way that you can sort of divvy that up in your head is that there's A shares, B shares, and H shares. And A shares are the things that foreign investors were not allowed to touch. They were China only, mainland China. Foreign investors were not allowed to get exposure to that. The A shares are the really important ones because they were just for mainland Chinese investors. But now all 3 of the index equity providers list them. So MSCI, FTSE, and S&P all have exposure to A shares. And that trickles down. Mutual funds have exposures, foundations have exposures, the Federal Thrift Retirement Investment Board has exposure. And that's a big deal for a couple of reasons, according to the SEC, because you have fraud, right? Like there are some fraudulent practices in Chinese companies that are not documented the same because they don't have the same accounting practices that the United States does. So volatility, mainland China is currently dominated by retail investors. So think of what happened with GME, but like times 10. And then corporate incentives. So the Communist Party, and this is probably like a key point about the government, the Communist Party, quote, in companies, Communist Party organizations shall be set up to carry out the activities of the parties. These companies do not exist for the benefit of shareholders, for the benefit of stakeholders like it does in the United States. They're not around to maximize shareholder return. There's also accounting practices. So more than 80% of Chinese bond issuers are rated AA or above, which is insane. That's like the best one rating you can get is AAA. So that's just like everybody, that's like 80% of Americans running in the Olympics. National security risk. So some of the companies that are considered entities so dangerous by US governments are in these indexes, which seems weird, right? It seems counterintuitive that something that the US government would be like, hey, we're not going to interact with them because they're a bad actor, is in an index where all these retirement boards, where these pension plans, where these teacher plans have exposure in their portfolios. Like seems a little funny to me.
What's up? It's me. It's editing Kyla and also adding some more things, Kyla. So I wanted to just add a few more things about the Tencent crackdown. China did another crackdown. They cracked down on Tencent, which is a big gaming company. They said that gaming was spiritual opium. But I also wanted to highlight 2 more aspects to this whole story because there's so much innovation that exists within China. Rex Woodbury wrote this really excellent article about all the stuff that Chinese companies have built. 5 lessons from China internet companies, sort of engage users, how you can build community online, social serendipity. China internet companies have mastered that. They're very, very good at building apps and building places where you can learn. The edtech space there is phenomenal. In social commerce, they have that down pat. The US could never do what China does with social commerce. So yeah. And then also Ray Dalio had a piece about China and sort of the crackdown that, as we know, the crackdown that's going on, and mentioned that most of the crackdown was happening because China wanted to, have things be more accessible. They want to have more equality. The issue with market cap weighting, where sometimes things that are we see this in S&P, right? Where some very, very big companies make up most of the S&P, Facebook, Apple, because they have such big market caps. And so it's just the same issue in the indexes, where China is such a big country, where it tends to take up a little bit more room, and because of all the stuff going on, it can be for better or for worse. So let's get back to the video, Kyla.
Happening now, JPM basically released a memo that said the worst case became the reality with the rise of Chinese education stocks, and a lot of broad EM and thematic ETFs hold these companies, and they're exposed to that risk, that downturn risk. Private tutoring firms already have to register as nonprofits. They're banned from raising funds via stock markets or foreign investment, and violators will be rectified. Which sounds It sounds concerning. So here, long-term growth and regulatory risk come to a pin. So everybody says you can invest in China for the long-term growth, but the regulatory risk is currently outweighing probably the benefit of the long-term growth, especially with regards to the overexposure. So the main deal is that there's an overexposure to Chinese companies in the EM indexes, increasing exposure to them due to the market cap weighting structure of the indexes, resulting in funds having overexposure and resulting in asset managers having overexposure to this over volatile cycle as well. And so China wants to invest in hard tech, and they're going to redesign their stock market to make it happen. And there are a lot of other reasons for this, but the main things is that China does not see tech the same way that the US sees tech. However, US tech investors who invest in China think that they do. There is an underpricing of risk in Chinese stocks, resulting in a feedback loop of indexes, fund managers, and asset managers having overexposure. And when a bloodbath does happen, because China doesn't see tech the same way that the US does, the feedback loop gets smashed. Tracy Alloway had a pretty good tweet. There was a saying in the past, go to the countryside, to the frontiers, to the places where the motherland needs it most. In fact, it is the same in investing and doing business now, and go to those industries that fit the central government's general policy, are in line with the same new pattern of future development. So basically, fund structure, endowments, pension plans, 401ks, the broad EM indices are all a part of that. Overexposure to uncertain risk, just due to fund structure.
Sponsored by Perth and the Freedom Index, solve some of the above issues by investing in companies that prioritize personal and economic freedom, which focuses on civil, political, and economic rights. The Life and Liberty Freedom 100 Emerging Markets Index is a freedom-weighted EM equity strategy that uses personal and economic freedom metrics as primary factors in the investment selection process. So go check that out. The link will be below, but there's ways to invest where you're investing in things that you believe in, right? Which is always the main goal.
This one was a little bit more serious than I normally do. It was a little bit more serious than I normally do. So if you like this, I do weekly videos around different ideas in the market and also do a weekly market update. So go ahead and hit that like button and also hit that subscribe button. Seriously appreciate you hanging out with me. It's always a good time, and I'll talk to you soon. Thanks. Chat again.